Yeah, it might sound a little bit exaggerated, but if you look back at history, silver has always been the money of the people. It has been like taken away or demonetized since the mid to late 60s in most Western countries. But I think that if you look back at 1980 and 2011, you had two major crises there. The first one was the dollar crisis. As some people probably don't remember. I don't remember it, but I've read about it that in the late 70s, like 78 and 79, the U.S. Treasury issued what they called Carter bonds. They were U.S. Treasuries denominated in Swiss francs and Deutschmarks because no one wanted dollars. So, yeah, in 1980, January 1980, yes, the Hunt brothers did try to corner the market eventually, and the regulators stepped in and stopped people from going long silver, and it stopped that speculative move in silver up to 50. But Paul Volcker was the chairman of the Federal Reserve, and I've read that he's commented after the event that there were some brokerage houses that were in trouble that could have gone under. It could have brought probably the whole banking system under. And eventually, he had to allow short-term rates to go to 20%. A few months later, or back in 81, 10-year treasury yields rose up to 15.5%. So yeah, I think silver was like the canary in the coal mine, so to speak. And in 2011 as well, when we almost touched 50, that was right at the beginning of the sovereign debt crisis in Europe, of the PIGS, which was an acronym for Portugal, Italy, Ireland, Greece, and Spain. And eventually, in the summer of 2012, Mario Draghi, the president of the ECB, he came out and said, we're going to do whatever it takes to save the euro and stop this sovereign debt crisis from spreading. And whatever it takes, of course, was money printing. It wasn't raising rates like Paul Volcker did in 1980, because nowadays, Elijah, there's so much debt in the system that you can't raise rates anymore to solve a crisis. You've got to cut and print more. Yeah, that's the problem nowadays. The debt is so high. Raising rates doesn't solve anything. They raised rates in the 80s to bring back investors into the dollar. They did that in 1992 here in the UK as well. When the pound collapsed, they raised rates to try to attract investors. They reversed those hikes very quickly. But nowadays, the system is so leveraged that they have to keep. Well, they'll have to cut or print more. And what a move above, towards 50 or even above 50 in silver, which I think is highly possible, would signal as a crisis. I don't know. We will find out. I think it will probably be afterwards, just like it was kind of in 1980 and in 2011, or it could be concurrent as well. And what could it be? Well, you were asking me about the Japanese government bond market. It could be that. Japanese long-term government bond yields have been spiking massively in the last 18 months. They've gone from being near zero and sometimes even negative, like in the 10-year, to now being 1.6 in the 10-year and above 3% in the 30 and 40-year. In Japan, the Japanese government debt to GDP is like 250%. And I've even read, Elijah, that rice prices in Japan, they've doubled in the last year. And that's like a staple of their diet. So the Japanese central bank, the BOJ, is really between a rock and a hard place, because they can't really cut, because their CPI is running like at 3.5%, 4%.